And with this, ladies and gentlemen, let's talk about the next topic. Well, it is investment for growth, lessons learned from large restaurant organizations on the road to scale. And to moderate the session, to lead the session, I'd request Ms. Ritu Marya, Editor-in-Chief, Franchiseindia, to please join us on stage. Can we please welcome her with applause? Let's do it loud together. I now would like to invite our speakers on stage. Please welcome Mr. Ashish Kapoor, MD, White Hat Hospitality, to please join us on stage. Let's hear it loud together for him, everyone. I'd love to welcome Ms. Syesha Kapur, Associate Director, Silver Beach Entertainment and Hospitality. Let's hear it loud together for her. Mr. Kabir Suri, President-NRAI and co-founder, Azure Hospitality, to please join us on stage. We'd love to welcome Mr. Raghav Verma, co-founder Chaayos, to join us on stage. Mr. Vishal Anand, founder Moonshine Food Ventures, LLP, to please join us on stage. Ladies and gentlemen, let's hear it loud together for our session moderator and our panelist. And with this, I'd like to hand over the session to Ms. Ritu Marya.
Thanks. Thanks, Bhavna. And may I also request if you can just, I think Kabir is outside, so if we can just be queued in. And Raghav's joined us virtually. Hi, Raghav. Good to see you there on the screen.
Are you ready?
So, this is a pre-lunch session, but probably we're going to make this talk so interesting that you probably want to miss lunch and really talk more as we go at the end of the session. So, what has happened is that anything that could possibly be challenged in restaurants has got challenged during the pandemic. Sometimes you hit it so hard that there is really nothing else left to be fixed. So everything in the restaurant industry, which in the pre-pandemic days required fixing, we were so busy running our restaurants, our food business, that there was never any time to sort of look deep down into things and, fix things which required fixing. So I would say, whether it is shorter menus, whether it is your upskilling of your people, given the fact now you have curbside and you have takeaways and even outside dining for that matter. So I think all of those things have got sort of fixed in restaurant business, and in fact have probably brought that R&D in the restaurant business, which in regular times was always hard to achieve. Given that everybody was always in the hurry to do things. So in today's panel, we're going to talk about that if you're today looking at growth and you're looking at what you need to do with your business in order to be able to scale it, then we're going to take it up. And if you have any questions, may I suggest let's not just keep it towards the end, just raise your hands and give your point out here. So I'm going to start with you, Ashish. There has certainly been a flavor wherein we have run our restaurants very tightly. But, most of the our panelists here today run very high-end restaurants. So running a tight ship can be okay for times which are very, very excruciating, but always trying to do it is always detrimental to the business. So now, how do you sort of get around, it's a mindset which got built, but it needs to be broken and it needs to be sort of revived again, that, we need to run a business like the way a restaurant should be run. There should be full element of fun, experience. So what have you changed in your business that sort of balances out both the things, wherein you run that tight ship, but at the same time, the customer, your consumer is not feeling any way that they're not getting the experience that they wanted when they came to your restaurants?
Thank you, Ritu. I think fundamentally restaurants should be about a 60-minute vacation. Right? It's not a business of or, it's a business of and. Guests should be given great food, great service, great ambience, and everything, right? So just like a holiday would be, or just like a perfect vacation would be, we have to try and compress a 60 or a little longer time period into that restaurant visit. I think what's fundamentally changed post-COVID is, I don't think a new dimension has come in. I think restaurants have always worried and been worried about hygiene. I think that's always been, part of our core DNA. across the industry. But I think what's come out most strongly is the whole necessity to ensure trust and hygiene across the ecosystem. And I think that's a great thing because, over time, for guests also to be more confident about where they're going. So I think the element of fun, the element of service, this is it's been a very difficult time for the industry for the last 2 years, but it's bounced back. Guests have been, more than happy coming back. And it's largely been driven with a certain amount of comfort factor that they've felt seeing people who serve them still smiling through their gear of, protective gears and all, and making people comfortable, making them come back for memories, making them come back for special occasions. So I think the warmth of the hospitality industry is never going to go. It's just now, in fact, a little nicer with this greater bond of trust, of hygiene, and happiness and the vacation being there.
Yeah. And incidentally, when I was talking to them, I also got to realize, because I haven't been to Goa in a while, how big Goa has become as a restaurant and a food hub. So I think we all need to probably plan our next vacay over there. Let me come to you, Kabir. Now, a fundamental thing, and so we are social people, and we consume news every day, and everywhere, left, right, center, we're seeing capital being raised excessively in our industry. Not in our industry, but across industries. So I know that for a fact that liquidity is more out there than it was ever existing earlier. Now my question to you is that how can restaurateurs raise capital? What would be the right strategy for them to go about looking for capital that they really need to scale their business? That is one. And secondly, is the restaurant brand the core to raising capital, or do you think other aspects it should be done as a whole or in parts from a food service business perspective to be able to do it successfully?
Thank you. I think, the last 18 months obviously has affected our industry as it has in India and globally. I think a lot of investors were cautious in respect to investing into our industry based on the unknowns and how hospitality obviously took the brunt of it. What I am seeing and what is visible with the various IPOs that have happened, that the investor outlook towards the industry is coming back globally and domestically. And it depends on where you are in your journey of life as an entrepreneur, as a restaurateur. So, you have to make the decision. Are you looking for institutional money? Are you looking for, can you grow your business with internal accruals? Are you looking to partner your business through joint ventures where you participate and you sort of share the burden of capital requirements? So it depends, and you have to answer that for yourself. What is the right answer? There is no right answer because everyone's requirements are different, everyone's quantum of money is different, and everyone's reason to get into the business is different. Someone gets in because they're a passionate cook, chef. Someone gets in because they're a true business person who's looking to create a chain of restaurants. Someone gets in as a lifestyle because it just so happens they live in a certain city and they want to have the lifestyle of having access to food and entertainment. So everyone's in it for different reasons. So if I were to look at it from a professional financial methodology, you can go down the path of, your traditional, debt sort of raising of capital. That's one way of doing it. The other is obviously you form a joint venture where you can participate jointly. Third is that there is a lot of H&I money out there that is looking for this space because either they're looking to provide alternative businesses other than family-run businesses for their family members who also have interest in it. So a lot of people are getting into it for those reasons. Third is where you have landlords that partner with you, where they provide you the assets and the capex. So that is, in a way, indirectly a joint venture possibility. The fourth, again, is, you franchise your brand. So once you give birth to a brand, once you own the brand completely and understand the DNA of the brand, then you obviously facilitate the expansion on that where the IP is further monetized, right? So there are different ways of doing it. It's been tough to raise money in the last 18 months, like I said, but the tide is turned. And I think it's visible with the amount of new restaurants that are opening. Unfortunately, a lot of restaurants had to shut down. So there's been a lot of distressed assets available in the market as well, which is also a way to expand in the unknown COVID period, which is, that we've dealt with. But fundamentally, if you're trying to build a big business, you have to answer the questions yourself. Are you trying to do one restaurant or 5? Are you looking to make a chain? Then because the capital requirements for each bucket are different. And hence you have to look at it from a different approach. When I started my journey 12 years ago, we raised capital day one from institutions because we knew we were going to build a business. Yeah. I was not opening a business to open a nightclub and buy a Ferrari. That was not the reason I got into it. It was to create shareholder value and to create a business that was scalable. That's the reason I got into it, right? So everyone has their own reasons and methodologies of doing it.
Sure. Raghav, just to come to you on the same question. Now, raising capital, and you've done significant bit of it at Chaayos. How difficult was it for you to raise capital on a restaurant brand? And today, when you're looking at further expansion, what is it that you are trying to address from investors' needs perspective that would really help Chaayos to be able to raise more capital?
Thank you, Ritu. Are you able to hear me?
Yes.
Okay, lovely. So, I completely agree with Kabir. The first question to be asked for any restaurateur is, where do I want to get to? Be it a 5-year time horizon, a 10-year time horizon, or a 20-year time horizon. So for us, it was very clear that the market that we are operating in, which is chai, can be extremely huge, right? Every Indian consumes 2 cups of chai every day. There is also the potential to create a global brand around chai, which nobody has been able to do so far. So when we got into it, we were very clear that we would need institutional equity capital, possibly a debt route or some other route would not be able to get us fast enough to the kind of growth aspirations that we had. Coming to your question now, that what does an investor look for, and how did that play out in the journey that we did? Well, we speak to all our investors. After they invested, what did you actually see in us that got you to invest? So the size of the market is possibly that one biggest point that comes up. Chai being that often consumed, being consumed inside home, outside of home on a daily basis, it is just that size of the market that excites a lot of investors. And similarly, for anyone in the restaurant space looking to do a similar journey, raise equity capital, there is a requirement to have a large enough market to excite most venture capital investors or most private equity investors. The other thing, obviously, is the team that you build out, the kind of team you've put together, the kind of execution that you've been able to do. And the third point is how differentiated and how defensible is the entire product and market, and what kind of product market fit have you been able to achieve. So these are the three core things that an investor looks out for. And again, there are a wide class of investors. You've got those who would want to put in a much smaller check size than you would have. You have the typical venture capital investors, who are the private equity, then the hedge funds. So at every stage, you would have a separate outlook as to what is it that they want from an overall risk versus return perspective, from an overall what is it that they are looking for when they look at an exit from the capital they deploy.
Sure. And during the pandemic, has it been hard for food brands to raise capital, though while we are seeing a lot of funding coming in delivery concepts?
Yes, correct. So I think it has definitely been very difficult the last 1 year for anyone to raise capital. Uh, Delivery has grown because of people hesitating to step out of home. So dine-in has been subdued. Everybody's all the delivery aggregators, all of the delivery brands, cloud kitchen brands are seeing good uptick in sales. So that's something that's definitely been doing better for the industry. And yeah, lot of delivery only brands, cloud kitchen brands now getting funded. Uh, I I think I think that is going to get better for the dine-in focused brands as well, starting early next year itself, uh, because of the way that business is recovering for all of us.
Sure. Thanks, Raghav. I'm going to come back to you again. In the meantime, Syesha, I'm going to ask you this, that now we've seen, while of course pandemic has been disastrous, but nevertheless, we have still seen restaurants being opened. New brands, new restaurants still coming up. So how has the format of the restaurant changed now versus the pre-pandemic? You know, either it's in terms of location, leases. What are the aspects that look different in terms of opening now? Are the stores smaller, larger? What things that were not earlier there as part of the dining experience or the takeaway experience which have been put? So largely, what difference in formats are we seeing?
Good afternoon, everyone. So I'm going to break this into two parts for you. First things first is new restaurants opening. So a lot of us, pre-COVID, had already made our plans as to which restaurant will be opened. The places were decided, contracts were signed, interior work had started. So I don't think most of us can go back on those plans. So we have to kind of adapt to what's happening today and try to make the best of that situation and try to maximize revenue within the constraints that we have. So I think that's the number one, the part one to your answer. It's not like we can go back and, just get rid of those spaces or breach the contracts. So we have to plan differently to make sure that they work for us. Coming to part two, which is how do we make it work once we open it? So I think it's very important to first understand the brand. Every restaurant, like for us, I'm just going to use our restaurants, like an Estella is very different from a Silver Beach Cafe. So I wouldn't say cut corners, but I have to make the business sustainable. However, I can't use a template across all my restaurants. I have to make sure that what I do for Estella doesn't take away from its experience, from its true essence that we give to a guest. So the basics are obviously renegotiating with your vendors, working out something with your landlord. I think that's key because that's one of your biggest costs, and it's always like hanging on your head. So that's something that you really need to, and having a good relationship with your landlord goes a long way. If that's something you have managed to build, they'll want you to stay in that property. So I think that also your operational hours. So just to give you guys an example, we used to open Silver Beach Cafe at 7 in the morning for breakfast, all the way till 1 at night. Now, we saw that our breakfast crowd used to come around 9 a.m. So just by shifting it by 2 hours, I have actually reworked my staff timings. I have reworked electricity and a lot of other resources. So just small things like that, if you can work around, which is, it really helps, the below the line. So also optimizing your staff. So a lot of our staff is now multitasking and they want to make the extra buck, why not? So they're doing extra shifts when they can. And because we have so many restaurants, the centralized team, like say your social media or your marketing, they are doing multi-brands. So if you work on small aspects, you can control your below the line, definitely, because as we all are aware, we're not making the kind of numbers that we did pre-COVID. We're still not there. So yeah, I mean, there are ways to do it, but it's very important to know your brand, because you can't compromise the experience in the process of cutting costs. So that balance is very important.
No, absolutely, I agree with you. Vishal, I'm going to ask you the same question. You opened new restaurants during the pandemic, and as we hopefully look to be coming towards the end of it, so what changed for your restaurants? What aspects have you new aspects have you brought in, and some maybe old things that, possibly in pre-COVID time?
So going back to what Syesha mentioned, that pre-COVID we had certain contracts signed, so we had to honor them. And I think post-COVID, what has changed is that we've become smarter workers. We've tried to control costs. And so in terms of what changes we've done in the opening of our new restaurants, obviously hygiene has become the utmost, the most important factor when we are talking of guest experience today. So we've built everything around hygiene. We've made our restaurants more spacious. So that is one aspect which has really changed and which we keep working on. And we ensure that not only inside the restaurant, but the staff which comes. What the change we did post-COVID was we've created shower rooms for our staff in their lockers. So it's important that they come, they're coming from various places, so they ensure that they also maintain the same hygiene. So we've got that in place. So that's something as a standalone restaurant I had not heard of earlier, so we thought we'll implement that. Then we've released, in terms of opening new restaurants, we always think of growth most of the time. The lesson learned for us is we want to first ensure that we have enough reserves before we go ahead for the next leap. So as of now, we are ensuring that, for us, before we open the next one, we ensure that the existing ones are sustainable. We create reserves which helps us in any kind of waves which come, or any unexpected situations which may arise. So we're ensuring that we have our cash flows in place, we have our reserves in place to sustain. So sustainability for us has been most important.
So I think earlier we could still live on the edge, but now those times have really gone. Okay. Ashish, I know you were the first ones to step into Goa to open restaurants, and now it's become a cult of a sorts, so many new ones coming up. Do you also see restaurateurs now have the appetite to go and experiment with newer locations? I mean, I know Dehradun might just become that location with the peripheral expressway and, so many people looking at a second home in Dehradun. So do you think we're ready to sort of now go out and experiment with locations which are, let's say, not safe, in the safe zone?
I think, Ritu, frankly, all the restaurateurs sitting here have opened in spaces sometimes that have surprised others and created really incredible concepts. I've been to, post-COVID, I went to Worldmark and I saw some of the restaurants that he set up, and you could be sitting anywhere in the world. So I think absolutely, I think what makes the fabric of a city is really the F&B options of any city. So I think a lot of power in these tier 2 cities is that the rentals are a lot cheaper, people have traveled the world, exposure levels are high. So do they make economic sense? Yeah. I mean, today with supply chain largely sorted, local talent being available, absolutely. And, with COVID, international travel has become a lot harder. So in general, be it Goa, Dehradun, hill stations, Indian travel within India is booming. And I think it's a great time to really step out and create, great concepts in all these places.
Kabir, I know you've opened in London, which is a hard feat because, at times like this when international travel, as he said, is anyway challenged, but you went out and opened there. So do you think the time has come for Indian brands to step outside their boundaries, and would you encourage the restaurant industry to take that seriously as a big opportunity going forward? I know, Karan was in the last session and he's taken up Domino's in Africa. So, we're all extending ourselves. But I mean, what's your message to the industry on this?
Honestly, for me, the F&B story in India has just started. I think India is a very large country. Every state of India is a different country on its own. I think the domestic opportunity is far larger than anything else. That's point one. Our reasons to go to London I'll come to in a second. So I think, existing restaurateurs, if they're trying to build a chain, they must focus within India because there's so much more explosion in respect to consumption that's going to happen and it's visible. Second is, I think the last 18 months has taught us Indians to appreciate our own country. Most of us are always looking to travel abroad, but I think the 18 months has taught us to explore what's available in our own country, and I think that is going to convert for, like Ashish said, domestic tourism is going to remain and it's going to only grow. So given that opportunity, I think there's tremendous growth here. In respect to overseas expansion, it looks very glamorous to go overseas, but it's very difficult. You have to make sure you have enough capital in place. Cost of doing business is not the same as India. Obviously opening a restaurant during COVID or over the last 18 months is detrimental because with the opening, shutdowns, lockdowns, reopening, the only thing that supported businesses that opened in the last 18 months overseas, at least in the UK, was the fact that countries such as the UK provided furlough for supporting the employment of your manpower, which obviously was very beneficial for many restaurateurs to have survived. I think going forward, COVID is not over, so let's not kid ourselves, yeah? It will evolve as it goes, but we have to make sure whatever business we create, domestically or internationally, is sustainable and is ready for shocks. So if that means you have to modify your actual product, you need to think about that today for what's going to come tomorrow, because we don't know what's going to come tomorrow. So sustainability, coming back to what he said, Vishal, is that, earlier we were talking about survival. So it was survival, you need to survive, then you need to, revive, and then you thrive. Okay? So I think we're in the revive, we ain't thriving, we're reviving, but we might go back to survive, right? So we're going back and forth, right? So the question is, have you solved for domestically and internationally? Is your product, resilient? A. Do you have capital in place that provides that resiliency? Because without capital, you cannot survive. It may be internal accruals, it might be external capital, it might be shareholders that have capital to provide, whatever the way to get capital is, line of credit, whatever it is. So, if you have all those things checked, then entering an international market makes sense, even with the uncertainty. If you don't have that checked, I don't recommend it to anyone, because we've gone through that journey in the last 18 months, and it is not something that is easy to handle. It really isn't. And also, doing business in Dubai or London or anywhere else in the world, yes, you're earning in dollars and pounds and dirhams, but the costs are the same, right? So when you say I'm doing 30 crores of revenue, but that 30 crores of revenue is because of conversion, your costs are equally the same. Labor overseas is the most expensive quantum on your P&L, post F&B cost, right? In some cases it's higher than F&B costs, right? Rent to revenue ratio is very low. It's normally under 10%. So the way we look at the business is inversely when you compare domestic business to international. When you look at a domestic business in India, rent to revenue ratios at many times in metros are touching almost 20% when you're paying revenue share in the malls or in high streets such as Bombay or Khan Market or expensive high streets. Whereas that same thing is 10% or 9% or 8% overseas, right? Whereas labor costs in India is under 20%. So you reverse the two, right? So what I pay in Khan Market as rental is what I pay in London for rent. But I'm earning 50 pounds per APC, average price per customer, whereas over here I'm earning $12 APC. So the math is inversed.
Yeah, it's better to be in London only then. I agree with you, and I think sometimes you have to take tough decisions, but they're important eventually for the sanity of the business and for yourself.
The question is, are you in this business for lifestyle? Is it because you just want to have fun? Or are you in it to make money? Once you solve that, or once you answer that for yourself, then you will make the right decisions, hopefully.
Raghav, now, I know at Chaayos you obviously have a mandate from, of course, coming from your investors most of the time, and also with the design of the brand, you have to open more locations. Now, I would say in the midst of the pandemic, what has changed about your location strategy? How do you now go about finding new locations and opening new stores? You're on mute, I think.
So Ritu, during the pandemic as well, we've been able to get quite a few good marquee locations. We've signed on with DLF and Cyber Hub. We've gone ahead with Phoenix Palladium in Bombay, Ambience Mall in Gurgaon. So I think there was an opportunity there also, since we had that capability to be able to take those few additional risks. In terms of the kind of locations, business parks is the only thing that we're a little slow with right now. But now that malls are also back, high streets are doing well. So fundamentally nothing has changed. And just to add to that point, I don't think fundamentally social behavior or offline behavior of customers is going to change in the long run. It's a matter of time. So we just need to structure all of those rental deals according to the kind of uncertainty that you see. Be able to build in into your rental terms that, if such a situation were to happen, how would you react to it? Do that handshake now as opposed to then bringing that up as a negotiation in the later stages when that event actually happens. I think COVID's made us wiser that way. To answer that question, fundamentally business does not change. I think we've managed to take a few good punts during COVID, which have given us a lot of confidence, maybe in the outskirts of the cities where we operate as well. There were some areas where we were not extremely confident before. We took a few punts, opened a couple of delivery-only kitchens, and then realized that there's actually a bigger market than what we actually took confidence on.
Sure. Another sort of question is that, so a lot of things changed for the business, right? I mean, AeroCity particularly was a hub for business meetings, and then business meetings stopped happening during the COVID. People were not getting together. So now those factors and that customer walk-in, and this is true for you too, Raghav. A lot of people used to pick up their tea or order it in office and stuff like that. So now that customer suddenly changed. So how did you compensate for that customer and that side of the business?
So yes, especially, not only AeroCity, but in Gurgaon as well, most of the offices were closed. So I guess we've suffered on lunch sale, especially. But I think the evening time has more or less compensated for the same, because people have worked all through at home during the day and wanted to go out in the evening. So that's where it has compensated during the evening. So that's what happened at AeroCity as well, where afternoon sales initially, when offices were closed, meetings were not happening, were much lower than compared to pre-COVID times. But in the evening, we could see guests flocking in.
So whatever time, of course, the restaurants were shut down. So how did and of course, not just that, so not just the pandemic, but overall, if you see the wage cost is rising, the food costs are rising significantly. How are you sort of trying to balance it out, even with increased sales that have started happening at the restaurants? Structurally, what are you doing in order to, within the dining space and within the non-dining space?
So what we are trying to do is, one, make everybody a multitasker within the organization. So if someone's at the bar, can also move to service. depending on what is the need of the hour. So we've done that. We're trying to ensure that we get into long-term contracts with our vendors, to reduce the cost. We're ensuring we've renegotiated rentals in some of the places that we are present. And I think with COVID, we've all realized, where rentals form the most expensive part or the costliest part of our cost. And we all have renegotiated rentals. And the landowners, the landlords, they've also realized that to build a sustainable long-term relationship, you need to be reasonable. And they also need to choose if they want to go with a long-term brand. Unlike what used to happen, I would see about 4 or 5 years ago, you would see a brand there for a year or two and then leaving, and then the landowner, they have to go back again to getting someone else. Over here now, even landlords have realized that they need to go ahead with more sustainable brands. So we are ensuring that we have staggered rentals. So first 2 years where we need to establish ourselves. Right now, what Kabir said, we are reviving ourselves. So first 2 years right now, post-COVID, we need to revive. And so we've all renegotiated our rentals in the first 2 years. And that's how even in future, whatever places that we are negotiating, we are ensuring that we keep the first 2 year rentals very low. I mean, in India, as Kabir said, 15 to 20% is somewhere we are paying rentals, but we are ensuring that we do not pay more than 12% anywhere. So even if I have to forego a prime location, doesn't matter, but I would not go beyond 12% on rentals.
Yeah, I think that's some real estate wisening up that has happened in the last few times. But at Horizon One, you would have faced the same problem too, right?
Which problem?
The problem of office or meetings or business meetings not happening.
It's a fact. I mean, it's a fact of life. We just all have to live through it. I think, frankly, Ritu, 18 mahine kaam hi nahi kiya. We're just all happy to get back. So it's great just being back in the restaurants, and there's some things you can't force. Like Kabir also said, inconsistency, start, stop, new variants. We just, fingers crossed, keep your head down, keep working, enjoy being back at work, and just let the market keep growing.
Sure.
And that's what's happening currently.
But who are the people who are coming in place of that?
No, I think it's absolutely right. Vishal's right that people are sick of working from home.
Yeah, that's true.
So there is a desire to get out. They haven't stepped out, met friends. So people are bouncing back. They are coming back. They're supporting restaurants. They've missed being there. You can't replicate that experience at home.
Yeah.
What delivery solves is a very different need from, you need music, you need people smiling, you need energy, you need pampering. All of that only happens in a restaurant.
Correct.
So that the people are coming back.
Yeah.
The delivery business is not going to ever take over the dining business. We have to always remember that. We as human beings always want social interaction, corporates, birthday parties. There's always something or the other going on.
Correct.
Date nights, just going out, whatever it might be. What delivery is going to gradually eat into is fundamentally cooking at home. So you have to break it differently. The number of times you would actually sit at home and cook or have it cooked or whatever is going to get replaced by ordering in. But going out is not going to get replaced. Yes, COVID comes and goes. You'll have those speed bumps. But this is not permanent either, right? So we have to deal with it. We're dealing with it. Revival is happening. People are actually, today restaurants are all full.
Yeah.
No matter where you go, everything is packed, right? So it's not that consumption's not there. And like, Ashish said earlier, domestic demand is fairly high because of the restricted international restrictions.
Yeah.
And this is here to stay at least for the next 6-7 months, for sure, right? And gradually it'll keep evolving, right? So the market's going to evolve, everything's going to. So it's all work in progress, right? And in the meanwhile, like he said, enjoy the ride because you've survived,
Yeah,
right?
that's
The most
true.
important thing was to survive. You've
Correct.
survived. So today you have to revive, and then you'll thrive.
Yeah, true. Raghav, you want to add something?
I think very nicely put, Kabir. That's the journey for all of us. Happy to have survived it.
Okay, happy to take some questions from the audience also, but in the meantime, yeah, we'll pass on the mic to you. Can kindly pass on the mic over there to the gentleman, please. Are restaurants talking today to corporates? Because obviously the canteens are gone, cafes within the corporates that used to exist, particularly for large corporates, they used to have their own canteens, they used to have their own in-house cafes. Now that's all gone. And while people who are working from home are still particularly for tech companies, it's still quite true, the situation. So are restaurants talking to managers or talking to HR teams to be able to compensate that dining experience that people had in the office to be in somehow by meal kits or some way to be done at home?
We operate in various cities of India, and what we've noticed is markets like Bangalore, where the SEZs are, Gurgaon to a certain extent, Hyderabad, where the tech parks are. Most of the tech guys were working from home for the last 14 months. No, 14. For the first 14, we're now entering past the 14. A lot of them got told by their companies to start coming back to work, which started in September, right? So from September onwards, we are seeing corporates come back in the tech areas and the corporate crowd in general, right? The choice is there because you're not forcing people to work, but the choice is there that you need to maintain minimum X number of days if possible in the office, blah, blah, blah. So what we are seeing is, yes, a lot of corporates are dining out because it's that same thing of, meeting people after so long, going out, you haven't done it for so long. So a lot of the HR, yes, are getting involved with restaurants and restaurants getting involved with HR. So we are seeing an uptake on that. So it is happening and it is increasing month on month.
Sure. Yes, sir? Yes, please go on.
Hi, I'm Utkarsh from Seed Cafe, Srirangapatna in the south. I have a small question to Mr. Vishal. The question is, how and why would you calculate 12% as your rental or your real estate?
Not able to hear you clearly.
Okay, how and why would you calculate 12% as your rental or real estate?
I think he said 5, no?
12, yeah. So why do we, because that's the global standards that people take between 10 to 12%. And when you are calculating in terms of, the other costs that are involved in running a restaurant. So if you have the rentals beyond that, then it's going to hit your bottom line substantially. So any rentals beyond 12% will only squeeze a bottom line.
So when you talk about business is all about uncertainty. So some month, you have a higher business, the graph is going higher, and some month the graph is going down. So how do you cope up with that?
So you take an average, and based on that average, you arrive at between 10 to 12% is the right percentage to consider for rentals.
So you mean to say, like, we can predict the business for the annual?
So we go by, the past experience. So we know that between October, November, December, the last quarter of the year is usually the best time for business. Then again, February, March are good months for business. So typically, 9 to 10 months in a year are good months for business.
Okay, thank you. In a way, would it be much more supportive by the landlord if there's a partnership with the landlord on a 10% stake or a 12% stake?
Sorry?
Would it be much more supportive to the business if there's a partnership with the landlord and 10% or 12% stake of the business?
So it depends, all individual landlords typically don't agree for revenue sharing models. But when it comes to developers or, they agree to revenue sharing model, which works in favor. sometimes it doesn't work in favor as well. When you start doing too well, you realize you're paying them more. So, you have to choose what you really want. And with developers, because they understand business better, they are in the business of leasing. So it's easier negotiating than individual landlords.
Thanks for answering my question, Vishal.
Thank you.
Any other questions in the house? Okay, I had one question, and this is primarily coming out of from where he's taken up. Now, when big brands do delivery, is it wise to do it under the same brand name, which has that, the aura of dine-in experience over there in customer's mind, or should it be done by a separate or a, different brand name, even though the food might have some similarities with the brand? So what makes more sense?
That's a good question. So I think, again, when you've built the IP, which is your brand, and you've spent the time creating followers and have loyalty, then the question is that, is it not easier to expand that or service the demand through delivery basis that brand? So in some cases, you're right, where you could dilute the in-dining experience. But it depends, it depends on what your APC is, what your experience is. It depends what your cuisine is. So European food is tougher to deliver in general, right? You can do your pizza, pasta, that's easier. But the rest of it is very tough. Asian food is easy to deliver. Indian food is easy to deliver, right? It's like you're putting butter chicken into a dabba versus a container. It's the same butter chicken. You have to reheat it, but the flavor, Indian food tastes better anyway the next day, right? Asian food, it depends what it is. Sushi is easy to deliver. Dumplings can be delivered. Your wok dishes can be delivered, they have to be reheated. So it depends what your cuisine is, A. Second is it depends on what your sort of outlook to life is. Because if you're looking to monetize your brand further and expand that, then it makes sense to do it. If you start, why do most cloud kitchens don't make money? Have you ever asked that question to anyone? Most cloud kitchens don't make money. The reason those assets make money is that you have to put 6 brands within one asset. Why is that? Because your AOVs are much lower, right? But when you have a brand where the AOV is 1,000 rupees, hypothetically, your unit economics on the P&L are very different. The lower your AOV, the higher the percentage you're paying Zomato and Swiggy. The higher your AOV, the lower percentage you're paying Zomato and Swiggy. Automatically, coming back to his question about occupancy cost, everything is interrelated on the P&L. Today's businesses have changed where delivery is a larger component of your P&L and your revenue streams. In our case, in our enterprise, delivery was 7% to my revenue pre-COVID. Today, delivery is 35% of my business, which is incremental revenue which I never had, because in-dining is anyway coming back, right? So look at what has happened for the better. You've opened up a new market which you were not servicing because you thought your product was not able to do it. But today we were forced to look and think out of the box. So you're now got delivery and dine-in both firing the cylinders. Today we spend money on delivery, which we never did in the past. Today we focus on packaging, which we never did in the past. Today we spend money on digital marketing, which we never did in the past. So the dynamics of business have changed because of COVID. The dynamics of business are evolving. Yes, you have lifestyle brands which would choose. I have Sly Granny, which is a lifestyle brand, where delivery is a small component, maybe 10%. But for Mama Guru, it's 35%. For Daba, it's 35%. And when lockdown happened, we've seen the evolution in the learnings. COVID 1 versus COVID 2. COVID 1, we didn't deliver. COVID 2, 100% delivery. That was the learning. So the asset was shut, but we were delivering, right? Which we couldn't do in COVID 1 because we were not prepared. Today, we are prepared for anything that's going to come. Because that's, I think, all our learnings from the F&B business, some that are already in the business and some that are new. How do you prepare for tomorrow? Because we don't know what's going to come. And how do you monetize and how do you sort of systematically look at the businesses with disruption on revenue? You know, the shock of going from X revenue to 0 was a shock I think most of us never expected in life, right? And then, so you have to now deal with how do you never let that happen?
Totally. Raghav, I know you'd invested in delivery business very early on, and I remember, how the chai used to come to offices, and large part of my teams used to order chai in the morning from Chaayos. So, how did you further, or how did you reinvest more on your delivery business during the pandemic? What sort of further you did on the delivery side of the business? And particularly, you had locations which were highway locations. I mean, how did the locations manage during the pandemic?
Yeah. So, the delivery, we started off in 2015, and delivery for us was already about 30% of our revenues pre-pandemic. For us, the thought was always that, if we want to build that chai brand which is very personalized and which is the preferred Meri Wali chai for every customer, we need to be available where the customer wants us. So if I don't have a presence in a particular office complex, I need to be able to get to that customer as well, because that customer is consuming Chaayos chai every Sunday at the mall, and when they want to have a great cup of chai in their office or in their homes, they should have an option of ordering Chaayos. So we had done a good amount of R&D over the last 5-6 years on what does it take to keep the chai hot, how do you streamline your operation so that the time required to make one cup of chai is minimized. So today that number is hardly 2.5 minutes, even though all the chais are made fresh. So we've done a lot of work on the turnaround time. To answer your question, has something specifically been done during COVID? Few product additions, especially around the immunity, be it haldi doodh, or be it a bigger variety of green teas. Some traction there, but wouldn't say something game changing. I think we just double down on the experience and the operations, and over a period of time just continuously doing things right over a long period of time compounds, and that's what happened, and today it's a greater than 40% contribution for us coming from delivery business.
Yeah, that's super. I mean, you said 35 and he's coming to a 40, so that's a different revenue stream which probably didn't even exist. Because Syesha, Vishal, you have very lifestyle restaurant brands. Do you ever feel the FOMO thing? Because obviously delivery is probably, even if you sort of invest in it and you do all the work in it, the delivery might still not be a large component of the business. But I mean, and if at all, how are you trying to address it?
So, for us, delivery has never been the focus areas because the kind of, even during COVID, the incremental business that we got from delivery was not, not so much to really make an impact on our P&L. But the cost associated with it in terms of real estate, staffing, it didn't make business sense to do it. So we didn't get into it. Yes, as a company into restaurants, we do want to have a right mix of maybe delivery brands, lifestyle brands, delivery brands, cloud kitchens. So that's something we'll probably take a call over time, not right now. As of now, our plans are a little different, but yes, sooner or later, we would want to get into that space as well.
Sure. So I think it really depends on the brand again. So, there are some brands and which you can actually do delivery from. Like if you can do justice to the food being packed well, it has to taste the same, the temperature has to be right. Like again, if we speak about Opa, it's an experience, the entire plate breaking, the dance, the food. It's like drama on a plate, You have the servers coming and making the hummus in front of you, and we have a chocolate piatto dessert which they just smash on your table. Now, how am I going to pack that in a box and give the guests the same experience? It's close to impossible. And, some brands, like a luxury brand, I feel it works in our favor when there is anticipation to come and experience OPA. If it's so easily available, it will definitely dilute this brand. So again, like I said, it's very brand centric. Like Estella, we could explore it probably. The food is, if we pack it really well, it's something that guests would enjoy because, it's a nice mix of Asian, continental, European. So we could do a separate delivery menu, which is obviously a shortlisted version of our master menu. But some experiences you can't replicate at home. I feel like maybe, delivery can grow, but it's in its own space. It's parallel. It will never ever replicate the experience of dining in a restaurant because, the entire, when guests are planning where they want to go, they dress up to go out, they go for the experience, it's an experience, it's a day out, which you cannot do in your pajamas at home, So, you have to be smart enough to know which brands you can plug into the delivery section and which brands just stay as it is. Even if you are, you're letting go of a few bucks of delivery. Even if you're letting that go, it's fine because you can't dilute the brand at the end of the day. So it's a thin line, but you have to make that choice.
No, you're right. Yes, sir. We'll pass on the mic to you, please. Can you pass on the mic here to the gentleman here on the table? Okay. Okay, we'll start from there. Yes, sir.
Hello, everyone. Harsh
Yes.
this side. As you told that delivery is not going to overtake dining. What if they work with dealing each other? When dining is in trouble, just like the pandemic came, then dining can help, delivery can help dining. And when delivery is in trouble, then dining can help delivery. Because at the end, we both are the part of this industry.
Sir, you'll have to get up and be a little louder. Even I couldn't follow it.
Ma'am, Harsh this side. As you told that delivery is not going to overtake dining. Yes? What if they work with dealing each other? If whenever dining is in trouble, just like the pandemic came, then delivery had help to the dining. When delivery is in trouble in future, then maybe dining can help delivery. So if they work with dealing each other, not overtaking, they can work equally. Just not think about overtaking because they both are at the end they both are working in same industry.
Yeah, so it's
No, so we never said one will overtake. We just said it will not replace. So basically replacing means the same thing as what you're saying, which means that they will both complement each other, right? What we are saying is that delivery will replace gradually the number of times you eat at home and cook yourself, right? So what we're talking about is when you cook food yourself at home, delivery will gradually more and more replace that. So the number of times you order at home will increase and the number of times you cook at home will decrease as we get more and more urbanized, as we get more and more disposable income, as tier 2 becomes tier 1, as tier 3 becomes tier 2. It's the basic consumption which will gradually change that. And why do I say that? Because that is prevalent in global markets. The times that you order in is far greater than the times that you cook yourself at home. So delivery will never replace dining out. Delivery will gradually eat into cooking yourself at home.
Sorry, sir, but you choose the word overtaking. That's why I asked that.
No, it will never overtake.
Okay, thank you, sir.
we take the last question here from the gentleman, please.
Hi, this is Devinder Kumar representing Khidmat brand from Kalkaji, which has been in existence since 30 years. Question for the gentleman on the right. It's on pricing, restaurant versus delivery. right? If I order a particular item from Kanmaki restaurant, right, and I get the same price as I would have been charged while dining in the restaurant. Now, my question is that it should be the same, because there are restaurants who are charging same price if you order a portion of pasta at Big Chill at the time of dining versus delivery, right? And you find the delivery is not at par with certain brands which have come in the market from Cloud Kitchen, which is world-class packing. So what do you have to say? Should it be, my question is, should it be the same or should it be lesser?
So, sir, it depends. Existing assets that are sitting in marquee markets such as the Khan market, where real estate costs are what they are, for them to discount pricing and provide the consumer the same product at a lower price is not going to justify, like Vishal said, doing delivery, right? Because you can't service, your fixed costs cannot get serviced. Cloud kitchens in general do not open restaurants or kitchens in high footfall markets or high visible markets or high real estate markets, right? They look for 50, 60,000 rupee rentals. The mathematics are very different on the P&L. So we have to look at it in two ways. Existing brands that have had to get into delivery. Big Chill, you use Big Chill as an example. Big Chill never did delivery in the past. Big Chill was forced to do delivery because of COVID, right? And Big Chill is not on Zomato and Swiggy. Big Chill only delivers themselves, FYI, right? But they were forced to do it because of COVID. Now, many brands that get into the delivery business are getting into the delivery business because that's their core decision. Many brands that were dine-in restaurants were forced to do delivery or chose not to do delivery, right? You have the choice, right? So restaurants that are dine-in concepts that are also now getting into the delivery business have to solve for two things. If you are wanting to expand your brand through cloud kitchens and delivery kitchens, then obviously you will follow the cloud kitchen methodology, which basically means rent to revenue ratio needs to be X, because you have to pay commissions to the like of Zomato and Swiggy for delivery. So technically the way to look at it is, if you're paying 20% to Zomato and Swiggy, and you have to pay 20% rent, that's 40%. But when I'm doing dine-in, I don't have the Zomato Swiggy 20%, right? So you have to look at the mathematics on the P&L to see which model, or if you're doing both, how that has to happen. That's point one. Second is, should pricing be different on delivery or should it be lower or higher? Please also understand, in dining restaurants, there's a component called service charge, right? Technically in delivery, there is no service charge. So technically in delivery, service charge is anyway, you've got a 10% discount on delivery because the costs are lower by 10%, right? Because there's no service charge. What restaurants do is they charge you packaging cost. So they put the packaging cost as a separate line item, or they put it into the pricing. Because for us to deliver to the consumer, there's a cost to packaging, which I don't need to deal with when I'm doing in-dining, because I've got plates and crockery, right? So the burden to deliver is getting transferred on the consumer, right? So because ultimately whoever's in this business is not in the business to lose money. You're in the business to make a profit like you do in any business, right? And so as a result, you have to look at the numbers, you have to look at the mathematics, you have to see where it sits. A purely cloud kitchen business does not make, 25% EBITDA or 20% EBITDA, right? You have to have multiple brands within one asset where your fixed costs are monetized through variable costs and through variable revenue. That's why you see cloud kitchens operating 3 brands or 5 brands, because each brand will do 3 lakhs, right? Or depending on the AOV. So it depends. It's sort of, pricing is dependent on which market you're in. Operating costs in metros are much higher.
I am of the strong opinion that the pricing should not be the same, number one.
Yeah.
During COVID also, I've tried food from various 5-star hotels. They had to sell food at a lesser price. Similarly, in my opinion, the restaurant dining versus delivery prices must differ. Then only you can see a growth. Otherwise, you will continue maintaining that 10 or 15% ratio Because today, it wasn't there earlier. Post-COVID, if you see some of the world-class brands have come in South Delhi. Even dining restaurant cannot match their packaging. They are charging some amount of packaging, right? But they are still cheaper. The quality is far superior than even the restaurant. That's what I personally feel. In my opinion, pricing should not be the same if you really want to grow. Thank you.
That's fair.
So, the price that you see on your app when you're buying, when you're ordering food, if that's the same as the price that you see in a restaurant, you're seeing the final price. But we have a lot of costs to incur just to be able to make one delivery. So, for example, if we are delivering to you directly without, say, a third party involved, then of course we can reduce the price. We can all afford that little hit. But third parties take a huge chunk of their amount. So there are reasons why certain restaurants cannot price it lower. I mean, we would all like to, why not? But there's a proper reason behind us not being able to do that.
Well, sorry, I'll just take a few seconds more. Gentleman, little while mentioned
Sir,
that cloud.
may I request
Yeah.
if this can go offline?
Okay.
This
All right.
is a long
Okay.
discussion
Fine.
and we can genuinely have
All
it
right.
offline. So I know I am right
Maybe.
now between you and the food, so I'm not going to extend the session any further. But thank you so very much to Kabir, Syesha, Vishal, and to Raghav for joining us from off location. But this has been a wonderful session, and I think some great learnings that came out of it. And particularly my takeaway is that it is going to be dining and delivery, and you should make the best of both the worlds, whichever format you choose to go for. So thank you very much once again, and happy lunch to all of you.
Yeah, and before we open the lunch, I request Ms. Marya and the panelists to please stay on the stage. Can we get the mementos? And for the guests, I can certainly request you to proceed towards the lunch. I request everyone to please come back in the ballroom by 2:50 so that we can, be little towards the session being on time. Thank you. Please proceed towards your lunch.